Welcome to Saudi Aramco's Q3 2023 results call. We will be holding a question and answer session following the presentation. If you'd like to ask a question, please press star followed by 1 on your telephone keypad at any time. I shall now hand over to Mr. Peter Hutton to begin.
Hello and welcome to this audio webcast discussing Saudi Aramco's third quarter 2023 results. I'm Peter Hutton, Head of Investor Relations at Aramco, and I'm delighted that we're joined today by our CFO, Ziad Al-Murshed. Our webcast today will comprise a presentation followed by a question and answer session, and we anticipate the entire call to last around an hour. I would also like to remind you that this webcast and conference call are being recorded and to draw your attention to this cautionary statement. During today's presentation, we may make forward-looking statements that refer to estimates, plans, and expectations. Actual results and outcomes could differ materially due to factors we note on this slide. Please also refer to our regulatory filings and the website for more details. With that, I will now hand over to Ziad.
Thank you, Peter. Welcome, everyone, and thank you for joining us today. As we are approaching the end of the year, the company continues to deliver strong performance. This success is driven by both the quality of our portfolio and the commitment of our employees, to whom I offer my sincere thanks. Now let me begin by walking you through our strong Q3 financial performance. Upstream EBIT increased compared to the previous quarter, driven by both higher benchmark prices and by our ability to capture realized liquid prices at a premium to Brent, which more than offset the impact of reduced production resulting from OPEC Plus cuts. Downstream EBIT also increased, benefiting from stronger refining margins and positive inventory gains. Group net income and cash from operations, excluding working capital movements, were also up compared to the previous quarter. And the balance sheet remains strong, with gearing of negative 7.6% at the end of September. We continue to deliver high reliability and flexibility while maintaining our disciplined focus on costs. We are also progressing well in the execution of our growth strategy by investing in our expanding and integrated portfolio and by remaining the world's preferred supplier of conventional, low-cost, lower upstream carbon intensity barrels. At the same time, we are actively building industry leadership positions in lower carbon fuels and solutions. Our dividend distribution framework is both resilient on the downside while also sharing the upside. In Q3, we paid $29.4 billion in dividends. This included our first performance-linked dividend of $9.9 billion on top of our base dividend of $19.5 billion. Yesterday, the board declared a third quarter base dividend of $19.5 billion and a performance-linked dividend to be paid in Q4 at the same level as Q3 of $9.9 billion. The actual precise calculation for performance-linked dividend is $9.7 billion, which is largely unchanged, so the board decided to keep the performance-linked dividends at the same level as Q3, given that Q3 included a $3.4 billion payment for the Rongsheng acquisition and a higher buildup in working capital due to higher prices. We also remain confident in our forecasts of mid- and long-term demand growth. Clearly, there is some near-term volatility, and despite that, oil demand is currently at an all-time high. I will now turn to our progress in delivering on our strategy. We continue steadily progressing the execution of our strategy. We have demonstrated our ability to scale up our capital program over the past couple of years. This year, the scale-up of our capital program is a significant increase over last year's, which was a record in our history. Nevertheless, we remain confident in our ability to deliver, and we are comfortably on track and well within our capital investment guidelines provided earlier. As a result, we are now narrowing the capital investment guidance range to be $48 to $52 billion, including external investments. We will outline our CapEx expectations for 2024 with our full year 2023 results in March. In the meantime, as we have said previously, we expect our CapEx to continue to increase until around the middle of the decade as we implement our growth plans. With that, let me now highlight our progress on several key initiatives. In upstream, we continue to expand our crude oil capacity, with the first increase in capacity coming online in 2025. We also continue executing the growth of our gas production by more than 50% over 2021 levels by 2030 to meet growing demand domestically, while also adding associated liquids for export. We achieved a major milestone in the third quarter with the Hawiyah gas plant expansion being commissioned and brought online, adding approximately 750 million standard cubic feet per day of sales gas capacity. During the third quarter, we also announced the signing of agreements to acquire a stake in MidOcean Energy, which has interests in 4 LNG projects in Australia and plans to develop a more diversified LNG portfolio. We are also seeing significant progress in downstream, where our focus remains on locking in dedicated outlets to convert a higher percentage of our upstream production into chemicals and capturing integration benefits along the value chain. Also in the third quarter, we signed separate agreements for the potential acquisition of 10% strategic equity interest in Jiangsu Shenghong Petrochemicals and 10% of Shandong Yulong Petrochemicals. These two highly integrated refining and chemicals complexes have a total capacity of 720,000 barrels per day and chemical conversion rates of over 50%. Similar to previous acquisitions we recently announced, this supports our strategic target to increase liquids to chemicals throughput to up to 4 million barrels per day and to expand into high growth and strategic geographies. We are currently negotiating the amounts of crude oil and other feedstocks we would supply on long-term basis to both companies. We also agreed to purchase a 100% equity stake in SMAX, which is a fuels retailer in Chile and a net importer of refined products. We see this as having synergies with fuel supply from Motiva, with Valvoline for its growth in the region, and as a platform to build on the Aramco brand. In low-carbon fuels and solutions, we completed the financial close of the Shu'aiba 1 and Shu'aiba 2 PV solar projects with our consortium partners PIF and ACO Power. Aramco holds a 30% equity stake in these projects with a combined capacity of around 2.7 gigawatts, and with this we are steadily making progress with our planned target of 12 gigawatts of renewables by 2030. We also continue investing in technologies that could help lower emissions across our industry as part of a realistic and robust global energy transition. For example, we progressed our collaboration with the global automaker Stellantis with extensive testing of Aramco-provided prototype efuels, concluding that 24 engine families in Europe are compatible with efuels without any powertrain modifications. This has the potential to reduce CO2 emissions from existing internal combustion engines by at least 70% on a lifetime cycle basis. In addition, our non-metallic materials JV with Baker Hughes, Novel, commenced operations in Q3 at the King Salman Energy Park in the eastern province of Saudi Arabia. Novel's non-metallic production facility is now producing reinforced thermoplastic pipes, which will reduce both costs and the carbon footprint across the life cycle. On portfolio optimization, we continue to ensure we direct resources to where they generate the highest returns. In the third quarter, our subsidiary SABIC has announced it will be divesting Hadid, which is a metal products supplier. Overall, we are pleased with the progress we are making on our strategy execution. Let me now turn to our key operational and financial highlights for the third quarter. In Q3, we generated $32.6 billion of net income and a free cash flow of $20.3 billion. As I said, we also paid $29.4 billion of dividends in the third quarter, which is a combination of $19.5 billion of our sustainable and progressive base dividend and $9.9 billion being the first of 6 quarterly payments of our performance-linked dividend. In addition to increasing total dividends by 56% year-on-year, we continued to maintain a robust balance sheet with a balance sheet gearing of negative 7.6%. We continue to focus on maintaining a high investment-grade credit rating across oil price cycles. Also, as I mentioned earlier, we are progressing well with implementing our growth plans. Our capital investments are on plan, totaling $37.5 billion for the first 3 quarters of the year, including external investments. This is 42% higher compared to the same period of last year and further demonstrates our track record and ability to scale up our capital program as well as our commitment to growth. Zooming in on some specifics of our third quarter performance, which was robust due to a combination of operational flexibility and favorable prices and margins. Upstream EBIT was robust at $60.6 billion in Q3, which is higher than in Q2, benefiting from the increase in average realized oil prices. This was, however, partially offset by lower volumes in Q3. Downstream EBIT was $5.3 billion, which is significantly higher than the previous quarter. This is mainly due to stronger refining margins and positive inventory valuation movements resulting from much higher prices compared to last quarter. This was partially offset by weaker chemical margins. Putting all this together, our group net income was $32.6 billion in Q3, which is also an improvement on the second quarter. ROACE, which we report on a 12-month rolling basis, remains strong at 23.4%. So overall, we delivered high profitability, high cash flows, and a strong balance sheet in the third quarter. Let me now take a couple of minutes to highlight how we've been focusing on maximizing shareholder value. First, we continue to exercise fiscal discipline and invest in a unique set of attractive growth opportunities to drive underlying future free cash flow growth. Second, we are continuing to strengthen our financial position and diversify our financing sources with new pools of liquidity. We recently signed 2 heads of terms, one with Korea Trade Insurance Corporation and the other with Italy's Export Credit Agency, in order to add significant capacity to our financing tools. These would be similar to the framework agreement we signed earlier this year with the Korea Export-Import Bank, KEXIM, for facilities of up to $6 billion. Third, we are delivering on our clear mechanism for balanced and enhanced distributions, which, as I mentioned earlier, provides both downside resilience while also sharing in the upside. Finally, in the past, we acknowledged that daily traded volumes of Aramco shares on the TADAWUL exchange were not high enough to attract some investors, and we highlighted that we are focused on helping resolve that concern. I want to draw your attention to the chart on the right-hand side of this slide, which shows that over recent months, we've seen a material increase in our daily traded volumes, in fact by 3 times since the announcement of our performance-linked dividend, and this has also been assisted by new market-making activities by certain domestic banks. Now, before we go to Q&A, I want to summarize our dividend distribution mechanism to make sure we're all on the same page. With our focus on maximizing shareholder value through strong future prospects and free cash flow growth, our approach to dividends is based on 3 main factors. Number 1 is providing downside resilience through a base dividend that is not only sustainable, but also progressive through the years. Number 2 is providing a mechanism to share the upside with shareholders through the performance-linked dividend. And finally, by continuing to heavily reinvest in the business through unique, attractive growth opportunities. Back in August, we said that our performance-linked dividend payments would be adjusted on actual performance for the remainder of the 2022-2023 period and distributed quarterly through the end of 2024, at which point we would calculate performance-linked dividends based on full-year financial results starting financial year 2024. With that, as I've mentioned, we've declared a $9.9 billion performance-linked dividend for Q3, payable in Q4, in addition to the $19.5 billion base dividend. As a result, the total dividends paid during 2023 will total $97.8 billion. This is 30% higher than the dividends we paid to shareholders in 2022, and it is a clear and positive indicator of our ability to share excess cash balances while also maintaining a very strong balance sheet and reinvesting heavily, in fact, at record high levels in our 90-year history, in order to considerably grow our business. Meanwhile, the remaining performance-linked dividend payments for the combined 2022 and 2023 results will be actualized with Q4 results and announced in March with our full-year results. It is important, of course, to also keep in mind that all dividends are at the board's sole discretion after considering our financial position and ability to fund commitments, including growth capital plans, in accordance with our dividend distribution policy.